Why did the significant market-saving policy of reducing stamp duty result in a 200-point bearish candlestick in the stock market? Yesterday, the China Securities Regulatory Commission (CSRC) announced a market-saving policy of reducing stamp duty, leaving numerous stock investors calculating with their fingers. Compared to previous instances of stamp duty reductions, they were pondering how much this reduction could stimulate the stock market to rise and for how long. 200 million Chinese stock investors dreamt countless dreams overnight, envisioning the stock price index climbing over one mountain after another. However, today, as soon as the market opened, the stock market's surge failed to last even a second. It plummeted all the way down, resembling a breached floodgate, a continuous and unrestrained freefall. The opening price became the day's highest price, and by afternoon's close, a rare large bearish candlestick with a drop of over 200 points emerged, shattering the fantasies of these 200 million Chinese stock investors. Why is it that in the past, when stamp duty was lowered, the stock market would surge for several consecutive days, but today, a rare bearish candlestick has appeared? This is because the majority of stock investors overlooked a key factor. The reason behind previous stock market surges after stamp duty reductions was that at that time, China's stock market lacked short-selling mechanisms, particularly the involvement of Western financial giants like the United States engaging in short-selling. During that time, China's stock market functioned like a common pot for both institutional players and individual investors, where gains were only possible when stock prices rose. When stocks fell, both institutions and individuals suffered losses. Yet, a pivotal aspect of China's stock market reform today is the introduction of short-selling mechanisms similar to those in Western countries, often referred to as the buying long, selling short speculative trading. This has introduced the practices of short selling and participation by Western financial giants from Wall Street into China's stock market. The situation is no longer one where only rising stock prices bring gains. Instead, both institutional players and financial giants profit regardless of price movements, and they stand to gain even more when prices plunge significantly. In contrast, China's 220 million stock investors are now in dire straits. They have become vulnerable to manipulation and exploitation, suffering losses whether prices rise or fall. Therefore, while the China Securities Regulatory Commission announced a 50% reduction in stamp duty, an unusually large bearish candlestick emerged in China's stock market. This 200-point bearish candlestick, which is typically seen only during severe stock market crashes, appeared today, a phenomenon never observed under the context of major positive policies like stamp duty reductions. Today's Chinese stock market seems to have completely reversed the conventional patterns of stock market rises and falls, resembling the song Upside Down by Dao Lang. This is the inevitable outcome of the introduction of short-selling mechanisms and the participation of financial giants into China's market, a situation strongly opposed by left-wing patriot forces during its initial introduction. As a result of these dual introductions, the characteristic of China's regulatory authority controlling the stock market, creating a policy-driven market, will likely disappear. Today's significant positive policy announcement by the China Securities Regulatory Commission resulted in a rare large bearish candlestick, proving this point. Of course, if Western financial giants who entered China's market and domestic institutional players, following Western financial giants, wish to create a large bullish candlestick tomorrow or any other day, they can achieve this effortlessly using the stock index futures buying long, selling short mechanism. At this point, some might ask, Western countries like the United States also have short-selling mechanisms. So why do such abnormal occurrences rarely appear in their stock markets? The answer lies in the long-discussed factor class action lawsuits. The fundamental feature and purpose of class action lawsuits are to provide a legal weapon for the poor to constrain the rich. Retail investors in the stock market can sue market manipulators, the financial giants, without providing any evidence, compelling them to compensate for the investment losses of these investors. Here's a real story to illustrate the restraining effect of class action lawsuits on these financial giants. In the 1990s, the United States experienced a decade-long bull market, yet its retail investors did not profit. This phenomenon, normal in both past and present Chinese stock markets, is evident. Retail investors had no options other than suicide or leaving the market. However, similar to the American working class, U.S. retail investors are not easily oppressed. They used class action lawsuits against 300 securities companies in court, attributing their failure to profit to the improper manipulation of stock prices by these financial giants. The court's judgment, rooted in class action lawsuits, was simple. The 300 securities companies had to prove their lack of involvement in the retail investors' losses. Otherwise, they would have to compensate them. Collaboratively, these 300 securities companies, although knowing the red-eye syndrome and deception behind the retail investors' claims, couldn't demonstrate their lack of liability. Continuing the lawsuit would have meant disaster for them all. So they collectively contributed $3 billion to compensate the retail investors proportionally, finally ending the case. Most intriguingly, the chairman of the U.S. Securities and Exchange Commission represented the class action lawsuit against the 300 securities companies. After winning the case, this chairman explicitly stated that the victory was entirely thanks to the U.S. class action lawsuit system. This article by the chairman was published in full in the China Securities Journal at the time. Although we loudly advocated for the introduction of the class action lawsuit system into China's stock market regulation, the new liberal economists and officials who led China's privatization reform at the time vilified our appeal as extreme left. Today, this call of ours is framed by the Five Mao Party as a way to glorify the United States and denigre China, transforming this system, fought for by the working class and laborers in Western countries for many years, into an element excluded from China's judicial reform, all under the label of complete westernization. This is the reason why China's mainland stock market has experienced a downturn from 2008 to the present, while the rest of the world enjoyed a 15-year bull market. This is the reason why China's stock market, previously at similar levels as the U.S. stock market, both around 6,000 points, now lags far behind the U.S. stock market, which has exceeded 36,000 points. Meanwhile, as the engine of the world economy, China's economy has grown at high speeds for decades, making it the world's only market with a declining stock index. A significant reason for China's stock market decline is its refusal to implement the class action lawsuit system, which represents advanced political civilization.